I want to talk about one of the biggest misconceptions I see in the real estate world. And honestly, it's costing investors a lot of money, a lot of stress, and sometimes even IRS problems later. Everybody online keeps repeating this magical number, 750 hours. People hear that and think, perfect. If I just hit 750 hours, I automatically qualify as a real estate professional and I can write off all my losses. And unfortunately, that is not how it works. This is exactly why so many investors think they qualify, file their return confidently, and then later find out they actually failed the test. So, if you own rentals, if your spouse owns rentals, if you are trying to offset high income with real estate losses, or if your CPA told you just track 750 hours, this is really important conversation because the 750 hours rule is only one piece of a bigger puzzle. And honestly, it's usually not even the part people fail. Most people fail because they don't understand the other requirements. So let's simplify this in normal language, human language, because the tax code definitely doesn't make it easy. Qualify as real estate professional for tax purposes. There are really two major tests that are happening. First, yes, you need more than 750 hours in real estate activities during the year. But second, and this is the part people completely miss, more than half of your total working time has to be in real estate activities too. So the second rule destroys a lot of strategies, of people's strategies. Because I will see someone with a full-time W-2 job working 2,200 hours a year full-time, and then they produce, proudly track 800 hours managing rent, and they think they won. They think they're doing good, but they didn't because the IRS look at total working hours. If your primary career is not real estate, you often fail the material participation rules even if you cleared 750 hours. And this is why social media tax advice get dangerous. People hear one rule, not the whole framework. And now here's another big mistake I see. People think owning rent automatically counts towards the hours. No, investor hours are not the same as material participation hours. Scrolling Zillow at night, it doesn't count. Listening to real estate podcasts, it doesn't count. Even reviewing financial statements can get disallowed in some situations if you are acting more like an investor than active participant. The IRS wants to see actual operational involvement, managing tenants, coordinating repair, advertising vacancies, bookkeeping, meeting contractors, leasing activity, real operational work. And here is where it gets even messier. A lot of investors says, well, my spouse qualifies. Okay, maybe, but the spouse actually has to materially participate as well. And yes, the IRS absolutely asks for logs. And this is the part nobody wants to hear. You cannot recreate 3 years of mileage logs and our tracking the night before the audit. The trust me method is not an IRS approved documentation strategy. And honestly, some of the logs I see are wild. People claiming 14-hour workday while also working a full-time corporate job and taking vacations every other week. That's the kind of stuff that raises red flags fast. And look, I'm not saying people are intentionally doing something wrong. Most of the time, they genuinely believe they qualify because somebody oversimplified the rules. And that's why this matters so much. Because when real estate professional status is done correctly, it can be incredibly powerful. We are talking about potentially unlocking large real estate losses against high W-2 income, business income, investment income, and as a result, huge tax savings opportunity. But when it's done incorrect, you can end up with denied losses, penalty, interest, amended returns, and years of stress. And this is why proactive planning matters so much more than reactive tax filing. A good strategy is not just, can you make the deduction? A good strategy would be is, can we defend the deduction? It's a very different conversation. And honestly, this is one of the biggest reasons people come to us after already filing elsewhere. Sometimes nobody explains the gray areas, nobody reviews the logs, or asks whether the spouse actually qualified, or checked if the hours even realistic. They just checked boxes on software and hoped for the best. So if you are trying to use real estate professional status, please don't treat it like a TikTok loophole. This is an area where document planning and strategy really matter. And if you want help figuring out whether you actually qualify or whether there is a smarter strategy available, please reach out to us. We also put together a free real estate professional status checklist that helps you understand what hours count, what documentation you should keep, and the most common mistakes investors make. So if you want the checklist, send us a message or comment below with the word REP for real estate professional, and we will get it over to you. Honestly, if this topic surprised you, that's exactly why tax planning matters. Because sometimes the difference between a smart strategy and a tax disaster is just understand the rules before filing the return. That's it for today. Have a great week ahead of you, and I will see you next week.